Welcome to Kitco News. I'm Niels Christensen. Joining me today is Joyce Choi, Director of Fixed Income Strategy at BlackRock. Thank you for joining us today.
Yeah, thank you very much for having me.
So you just came off a panel talking about fixed income. I guess my first question is, 10-year trading 2.09%, trading near a 2-year low. Are bonds expensive?
That's a very good question. Again, we went through a period last year where the Fed was in a hiking cycle. However, there was a bit of a pivot earlier this year by the Fed Chairman Powell, indicating his expectations for growth to actually slow down into this year. So that pivot by the central bank kind of shifted the central bank policy, not only in the US, but also globally, whereby we expect actually more G10 central banks to actually be in a rate cutting or a maintenance of rates mode. So you're asking, is it expensive here? Well, we do expect actually 1 or 2 rate cuts in the next few months. So that would actually indicate that we should see 10 years actually start falling lower.
How low do they go? I mean, how low can they go? I mean, do you see negative yield? I mean, is that...
Well, we're already seeing negative yields in over $10 trillion of government bonds in Europe, in Japan. I don't think we're going to get there in the U.S. However, the bias is certainly towards lower yields at the moment, just given inflation expectations. And again, ECB comments yesterday, Draghi indicated that further QE is potentially in the pipeline, depending on growth trajectory on the back of all the trade tension. We also have the Fed today, and we have BOJ tomorrow, or later this week. So it's clearly going to be a fairly large week in terms of how central banks communicate how they expect rates to go in the next 6 to 12 months.
So you look at market expectations. I mean, CME FedWatch tool shows near 90% chance of a rate cut in July. Nearly 4 rate cuts by the end of the year. Do you think markets are too aggressive in the rate cuts, or are they can the markets be wrong?
Yeah. I do think that the markets have moved a little too far, too fast. Our base case is actually that the U.S. and Canada and North America should actually hold in well in terms of growth. Again, indications of the services sector, labor growth are still quite robust in Canada and the U.S. So again, with our base case being fairly stable and solid growth in the next 6 to 12 months, we do think that maybe the markets have overshot, at least in the front end of the curve, because again, we're still constructive in the next 6 to 12 months.
Everybody talks about the yield curve, the inversion of the 3-month, 10-year. Recessionary fears picking up on that. It actually did invert 6 months ago. So, now that it's inverted again, how do we take that? I mean, are we closer to a recession? I mean, obviously you're saying, steady growth. What's your take on the inverted yield curve?
So yes, our expectations are for steady but slowly declining growth. Recession is not in our base case, despite the fact that we did see the front end of the curve invert. However, there are a number of other data points that are quite important when we consider recessionary factors taking place, whether, again, leading indicators or we're still seeing fairly robust job creation. So again, we want to see a few of these other criteria start to get triggered before we make a final call. But again, nothing as of yet, despite the headline risk that we see with this global trade war or tensions, really affect growth that we foresee in the next few months. So
some optimism, lower steady growth. But 10 years, people are getting defensive. Is now the time to get into defensive assets? I mean, I guess bond yields can go lower. So should people sort of be overweight defensive assets?
Well, I think it's year to date, we've seen a fairly strong performance amongst risk assets. Global equities are up double digits, 10 to 15%, depending on which market you're looking at. So, for me, I'd like to tell advisors and clients to preserve your returns for the year. And how are you going to do that? And I think it's having some embedded fixed income in your portfolio allocation to provide that defensive and hedge against a multi-asset portfolio. So yes, it's time to get slightly get defensive through fixed income, and you can play that through broad fixed income exposure or through government bonds as you see fit. So.
That's perfect. Thank you very much for joining us here at Kitco News. Thank you for joining us. Stay tuned for more coverage from Inside ETFs Canada.